Sometimes a piece of economic news drops and it looks like a huge warning sign. But what if it's the exact opposite? What if it's actually the signal that a massive economic turning point is right around the corner? Let's get into it.
So let's start with this number, negative 258,000. It sent a real jolt through the markets. It represents 250,000 of something we all thought was there. But in reality, it just vanished. Poof. So get this, it's not a prediction about the future. It's a correction of the recent past. It means that more than 250,000 jobs we thought the U.S. had created in the early summer, well, they just never existed. This one little adjustment paints a picture of a labor market that was way, way weaker than the headlines were telling us. So what does a jarring number like this actually signal for the economy? Well, one prominent analysis has a surprisingly optimistic, almost counterintuitive take on it. This weakness isn't the beginning of the pain, it's the end. This argument, which comes from Cathie Wood's firm, says that this bad news isn't the start of a new downturn. Instead, they're saying it's the final proof that a very specific kind of recession, one we've quietly been living through, is about to be over. Now, to really wrap your head around that argument, you first need to understand the core concept it's all built on, the theory of a rolling recession. Okay, so instead of the whole economy just falling off a cliff at the same time, this theory says that for the last 3 years, different sectors have been taking turns getting hit. First housing slumped, then manufacturing contracted, and now finally the labor market is showing its weakness. So this jobs report, in their view, is the last domino to fall in a long staggered downturn. And this is where things get really interesting. This theory sets up the central drama of the entire economic moment right now, a really high-stakes standoff between the weakening data and the U.S. Federal Reserve. So, in one corner, you've got this whole pileup of weak economic signals. The housing market is struggling again, consumers are pulling back, and those key business activity indexes, the PMIs, they're shrinking. But in the other corner, you have what's called a hawkish Federal Reserve, basically signaling it's going to stay tough on inflation, keep policy restrictive, and not back down. And this right here is where this specific analysis really breaks away from the crowd. I mean, sure, everyone agrees the job market is weaker now, but this theory is way more aggressive about what happens next. It's predicting the Fed will be forced into significant interest rate cuts. We're talking 50 to 75 basis points. That's 0.5 to 0.75 of a percentage point before this year is even over. Okay, so let's play that out. If the prediction comes true and the Fed does a complete 180 on interest rates, what happens then? Well, according to this framework, that pivot is the one key that could unlock a surprisingly powerful economic boom. A huge piece of this optimism is tied to a specific fiscal policy that's all about encouraging companies to build things in America again. Onshoring. It would let companies immediately write off 100% of their spending on new domestic buildings and factories. The idea is to kickstart a massive wave of private investment, which then fuels a huge boom in productivity. And the potential impact of that policy is pretty stunning. The forecast is that it would slash the effective U.S. corporate tax rate all the way down to between 12 and 14%. I mean, just look at that. All of a sudden, the U.S. becomes just as tax competitive as famously low-tax countries like Ireland. That would be a huge magnet for global investment. And the ultimate prize for all of this? The analysis forecasts that this mix of lower rates and higher investment could fuel a sustained, productivity-powered GDP growth rate of 5%, or even more. That's a level of growth the U.S. hasn't seen consistently in decades. But okay, let's get real. No forecast is a sure thing, so any credible analysis has to admit what could go wrong. What are the risks that could completely derail this whole optimistic outlook? The analysis itself points to 3 big ones. First, the main risk. The Fed just stays hawkish. It refuses to pivot and decides to prioritize fighting inflation no matter how weak the labor market gets. Second, that big productivity boom from AI and new tax policies, maybe it just doesn't show up as fast as everyone hopes. And finally, there's always the geopolitical blind spot, a sudden conflict or trade war that could throw a wrench in everything. So, after all the charts, all the theories, and all the data, it really boils down to this one crucial thing. The entire optimistic case, the whole recovery story, It all hinges on one single institution making one very specific choice. And that's where we're left, with a compelling, even exciting case for a sharp recovery that all depends on one critical move from the Fed. So it leaves us with the final question, doesn't it? Are we really witnessing a major economic turning point? Or is the biggest risk of all a central bank that simply refuses to budge being seriously overlooked? That's the multi-trillion-dollar question for the entire economy.